Australians have been struck down by inflation since the first year of COVID, with price pressures knocking the economy ever since.
It's just a balancing act. Honestly, it's really, really hard balancing act.
Past 18 months, interest rates on my mortgage have gone up. I've had to refinance my house. Cost of everyday items has gone through the roof.
Even though costs have been increasing, businesses can't always pass them on. This bowling alley loses money on every steak or parma it sells.
If you add up the margins, it's what you're going to do. You need to charge $35 for a parma, but we don't, because no one's going to pay that.
In the 3 months to September, annual inflation fell to 2.8% and was 0.2% for the quarter, driven by price rises in food and overseas travel, particularly to Europe, and breaks at home during school holidays. Other price rises were largely offset by falls in electricity as households received energy rebates and fuel from lower oil prices. The Reserve Bank's preferred measure of inflation, which excludes volatile items, fell to 3.5% annually, down from 4% the previous quarter.
These new numbers show that inflation is at its lowest in almost 4 years. Our energy rebates are helping, but underlying inflation's come off substantially as well, and that shows that broader underlying pressures in our economy are easing considerably as well.
There is still a long way to go in this battle towards a strong low inflation economy in Australia. Temporary subsidies will not hoodwink the Reserve Bank of Australia.
Economists say the result isn't enough to shift the Reserve Bank from its holding pattern on interest rates.
We think that the RBA will need to see that underlying inflation measure come down a bit lower before they'll be convinced that inflation will not only return to their 2 to 3% target band, but actually stay there as well.
Inflation falling still means prices are going up, just by not as much as they have. Central banks around the world have been cutting interest rates after claiming success in taming inflation. But few economists expect that to occur here until early next year.
I don't think we will see a rate cut this side of Christmas, unfortunately.
Of the big four banks, only Commonwealth Bank thought there might be a cut to interest rates this year. After this data, they've pushed that tip back to at least February, joining rivals.
We think by Q4 it will be low enough that the RBA will be able to start cutting the cash rate at its February meeting.
The economy is slowing down.
Just finding a job that pays well enough to keep up with inflation is getting harder and harder and harder, even for someone with many years of experience.
His friend Rylan has seen inflation change his life too.
I used to be able to manage on a very kind of casual, temporary basis, but this year I had to get a full-time job and actually knuckle down and just look at getting steady income.
As the inflation fight rolls on.
The financial markets have also pushed back expectations for a rate cut. I spoke to Andrew Lilly, Chief Interest Rate Strategist with Barrenjoey. Andrew Lilly, welcome to The Business.
Thanks, Alicia.
Andrew, the CPI reading on a headline basis is back within the RBA's target band. That should be something to celebrate, shouldn't it?
Ordinarily it would be, but the problem is that at the moment, the government have their thumb on the scale of the inflation reading a little bit. So one of the reasons why inflation has fallen back into the band is that the government is applying cash subsidies to items that households pay for, in particular electricity. Now, this means that that headline inflation isn't exactly what economists think about when they think about prices. If you take out the effects of subsidies, then inflation is still a little bit above the target band. So the RBA is looking for inflation to be sustainably within the target band, and even though the headline rate's there, we're not really there yet.
And of course, that underlying reading is well above that 2 to 3% target band.
That's right. So underlying inflation is running at 3.5% year on year. And that's what I mean when I say it needs to be sustainable. Now, what we should think about when we think about underlying inflation is a lot like the way that we measure gymnastics scoring at the Olympics, which is the RBA take all of the items in the CPI basket and then they line them up from top to bottom. And then they chop off the 15% that have the highest and lowest inflation and average out the rest. And research has shown that's the best indicator of where broad inflationary pressures are. And at 3.5%, it's still 1% over the RBA's target.
So in spite of that headline coming down to the band, that's why interest rate expectations appear to be falling away when it comes to market bets.
That's right. So the market was pricing that an interest rate cut was more than likely by the February meeting. That's now fallen away slightly, so we're now looking at a cut being fully priced by around May of next year. So we've gone from the first to the second quarter in terms of what the market expects.
And how concerning is persistent services inflation? Because it seems to be that that's the things that people need to pay for: rents, childcare, the like.
This is mirroring what we're seeing offshore. So in most countries, what we've now seen is the pandemic really elevated goods inflation. There was a shortage of goods, a shortage of inputs across the supply chain, and there was also a shortage of shipping. So what that meant was that goods prices were temporarily elevated. Now they're coming down as those pressures fade. But the problem is goods inflation, while that is where it needs to be, it's somewhere between 1% and 2%, services inflation is still running at 4 to 5. And for the RBA to be at target, then services inflation really needs to be 3 to 4%. Now, for that to happen, we're going to need productivity growth to improve from here, because the problem with services inflation is you can only really get it down if productivity gets better.
And that productivity puzzle is still quite a conundrum for most. When it comes to rate cut expectations, they're falling away in Australia, but they're also falling away in the US. How is that playing out on the bond market and in currency markets?
So we've seen yields rise substantially. Yields on 5 through 10-year bonds are up almost 0.5% over the past month. And that primarily reflects interest rate expectations falling away, as you say, but there's also some concern around the timing of elections where people start looking at the sustainability of fiscal positions. Now, Australia's fiscal position is quite sustainable. We're in a very good state of affairs. It looks like the budget deficit this year is going to come in something between 10 billion or maybe even a balanced budget. However, if you look offshore to the United States, the budget deficit is in excess of 6% of GDP, and whichever party is elected, it's not looking like fiscal repair is on the cards anytime soon. So that has investors worried about the total supply of debt they have to take down, and so that's the second reason why bond yields are rising across the world.
And when it comes to the Australian dollar, I mean, it was pushing 69 US cents just a month or two ago. It's now at around 66. Are we expecting it to hold there given the outlook for the US interest rate situation?
Yes, we are. It's been remarkably stable. Now, if it was the case that only Australia's interest rate cut expectations were falling away, then we would have thought that the Australian dollar would appreciate, because that would mean you'd get a relatively better cash rate in Australia than you would in the rest of the world, while every other central bank cuts through the RBA's level. But interest rate expectations now are for everybody to land basically where the RBA are. So initially, we thought that the Fed might cut to the mid 3%. Now we think the Fed might cut to the low 4%, which means that Australia and the US, by the end of 2025, will probably have the same cash rate, and therefore the currency is likely to be stable.
And will the US election outcome, you did touch on it, but will the US election outcome change that forecast depending on who wins?
Yes, absolutely. I think a Trump win would probably be good for the US dollar broadly. It would probably also see the Australian dollar come off, because if Trump's elected, his first action would likely be to institute tariffs that are focused on harming China. Now, harming China will have a flow-on effect. It'll ripple out through Southeast Asia. And when you sum up all the countries in that region, that's around half of Australia's exports. So that would mean weaker growth in Australia. Australia would look like a relatively worse investment opportunity. So the Australian dollar would likely be depreciating against most currencies, and the US dollar in particular appreciating against Australia.
Andrew Lilly, thank you.
Thanks, Alicia.